This is it. The moment silver stopped whispering and started speaking loudly. Silver has officially broken above $80 an ounce. And this time, it's not speculation. It's not hype. It's not a paper rally. This is a structural break. For years, we were told the silver squeeze was coming, that it was always just around the corner, that the paper market still had control, that there was plenty of metal, that the vaults were full, that nothing had changed. That illusion just shattered. What you're witnessing right now is not a spike. It's a repricing. A repricing driven by something paper markets cannot fabricate. Physical scarcity. And it starts in the place most people don't watch closely enough. London. London is the beating heart of the global silver market. It's where spot prices are formed. It's where bullion banks settle trades. It's where liquidity is supposed to exist. And London is seizing up. For decades, London functioned because it always had a backstop. If metal got tight, supply would appear. Bars would be leased, metal would be swapped, inventories would float. But here's the critical difference between silver and gold. Gold has a lender of last resort. Silver does not. When gold markets tighten, central banks quietly step in. They lend, they swap, they smooth over stress. Silver has no such safety net. There is no central bank vault waiting in the shadows, no emergency stockpile, no invisible hand to stabilize supply. When silver disappears, it's gone. And that's exactly what's happening now. This isn't one drain. It's a convergence, a multi-front evacuation of physical metal. Let's walk through it. The first crack appeared earlier this year. Tariff arbitrage. Fears of U.S. import tariffs created a massive incentive to move silver from London to COMEX. The logic was simple. If tariffs were coming, metal needed to be inside the U.S. system beforehand. So bullion banks began pulling bars out of London, shipping them across the Atlantic, draining inventories that were never designed to absorb that kind of demand. That was the spark. Then came the ETFs. Over 100 million ounces of silver flowed into ETFs. And here's the part most people misunderstand. That metal doesn't trade. It doesn't circulate. It doesn't provide liquidity. ETF metal is locked, removed from the system, taken off the table, at a time when inventories were already thin. Then came India. Diwali demand collided with a market already under strain. Physical silver borrowing rates exploded. Lease rates spiked. The lending market seized. That was the warning sign. Because when borrowing rates spike, it means lenders don't want to lend. And when lenders don't want to lend, it means metal is scarce. Then came China. And this is where the situation moved from serious to existential. China is both a major producer and the world's largest consumer of silver, solar, EVs, electronics, grid infrastructure. And China made a decision. Silver is strategic. And it will be treated that way. Export restrictions, domestic prioritization, hoarding for national industry. This removes supply from the global market permanently, not temporarily, not speculatively. This is not metal that comes back. And remember, the world was already in deficit. This is now the 5th consecutive year where global silver demand has exceeded mine supply. 5 years of consuming more than we produce. 5 years of drawing down stockpiles. 5 years of pretending inventories were infinite. They're not. And here's the most important part. Silver supply is inelastic. 70% of silver is mined as a byproduct. Copper, zinc, lead, gold. Raising silver prices doesn't magically increase production. Mines don't flip switches. Projects take years. CapEx takes time. Permits take time. Supply cannot respond. Demand, meanwhile, is completely inelastic. Silver is not optional. It's not substitutable. It's not a design choice. Silver is the best electrical conductor on Earth. Physics doesn't negotiate. Solar panels require it. EVs require it. Electronics require it. Grid infrastructure requires it. Factories cannot shut down because futures traders need price stability. This is why this move is different. Back in 2011, silver surged on speculation, paper leverage, hunt-style behavior, margin-driven excess, and margin hikes crushed it. This time, there is no excess, only absence. You cannot margin call a shortage. You cannot print inventory. You cannot fake delivery. And then Elon Musk spoke. One sentence, no hype, no narrative, no pump. This is not good. Silver is needed in many industrial processes. That wasn't commentary. That was validation. The world's most influential industrialist just confirmed what stackers, miners, and analysts have been warning about for years. This is no longer a fringe theory. It's an industrial crisis. And markets heard it. The price didn't break $80 because of sentiment. It broke because the system ran out of excuses. Now zoom out even further. This is not just a metal story. It's a monetary story. Currencies are being debased. Debt is exploding. Sovereign balance sheets are deteriorating. Capital is fleeing abstraction and moving toward tangibility. Gold, silver, energy, land, assets that cannot be frozen, cannot be sanctioned, cannot be printed. And this is happening globally. Eastern nations are draining Western vaults, not for profit, for security. Metal is moving east, and it's not coming back. This is why paper prices stopped mattering. The futures market can quote whatever it wants. But when delivery is demanded, reality decides, and reality just voted. $80. This is not the end, it's the beginning, because nothing that caused this move has been resolved. Supply is still constrained. Demand is still accelerating. Inventories are still falling. Trust is still eroding. The only thing that changed is denial became impossible. If you're holding physical silver, this is not the moment to flinch. This is the moment the thesis validates itself. If you're not holding, the window is narrowing, not closing politely, but tightening. Because once physical availability disappears, price becomes irrelevant. You cannot buy what does not exist. And the silver market is rapidly approaching that threshold. Now let's talk about what happens next. Because when markets break structurally, they don't move in straight lines. They move in phases. The first phase is disbelief. That price won't hold. This is overextended. Silver always crashes. That phase is already fading. The second phase is forced acceptance, where participants realize the old tools don't work anymore, where paper selling no longer creates supply, where volatility increases, not decreases. That's where we are now. Silver above $80 is not expensive, it's revealing how distorted pricing had become, revealing how leveraged the paper system really was, revealing how little physical metal was backing global claims. And this is where things get uncomfortable. Because once price breaks a psychological barrier like this, control shifts, banks lose dominance, futures lose credibility, narratives lose power, physical buyers take over, and physical buyers don't negotiate, they secure supply. This is why the gold to silver ratio matters now more than ever. At $80 silver, with gold near current levels, the ratio still sits historically high. For over 2,000 years of monetary history, the average ratio floated between 10 and 15 to 1. Today, we're still far above that. That tells you something critical. Silver is not overbought. It's still undervalued relative to gold. And historically, when this ratio snaps back, it doesn't drift, it collapses violently. That's how silver moves. Slow suppression, long frustration, then sudden repricing. This is why $100 silver is not a headline. It's a math problem. If gold holds steady and the ratio compresses modestly, triple-digit silver becomes unavoidable. And here's the part most analysts won't say out loud. Silver doesn't need new buyers. It needs continuity. Industrial demand is already locked in. Solar manufacturing doesn't stop. EV production doesn't pause. Electronics don't redesign overnight. Every ounce not mined must come from inventories. And inventories are finite. This is where volatility explodes. Expect sharp pullbacks, violent intraday swings, engineered sell-offs, margin pressure. Not because the thesis is broken, but because the system is under stress. Volatility is not weakness, it's evidence. When markets are healthy, they're calm. When they are breaking, they're erratic. Paper markets are fighting for survival now. They will attempt suppression. They will raise margins. They will shake out leverage. They will amplify fear. But none of that creates silver. This is the key difference from every prior cycle. In 2011, selling pressure created supply. Because metal existed, in 2025 and beyond, selling pressure exposes absence. And absence is fatal to paper markets. This is why delivery matters more than charts. Why vault reports matter more than RSI. Why premiums matter more than headlines. Watch what doesn't move. If prices pull back, but inventories keep falling, the trend is intact. If prices drop, but physical premiums remain elevated, scarcity remains. If paper volume collapses, but physical demand persists, control has already shifted. This is not a trader's market. It's a transition market. And transitions are brutal. Some will sell too early. Some will panic. Some will over-leverage and get shaken out. But those who understand the structure, understand patience matters more than timing. This is not about catching the top. It's about not missing the revaluation. Because when markets reach this stage, they don't revert to normal. They search for a new equilibrium. And that equilibrium will be higher, not because of speculation, but because of necessity. Now let's zoom out one final time. What you're witnessing is not just a silver event, it's a credibility event. A moment where financial engineering collides with physical limits, where leverage meets inventory, where promises meet delivery. For decades, the system worked because trust filled the gaps. Trust that metal would be there. Trust that settlement would happen. Trust that supply would appear. That trust is eroding. And when trust erodes, price is no longer a negotiation. It's a verdict. This is why silver is being remonetized quietly, not officially, but functionally. Because when currencies weaken, when debt explodes, when geopolitical risk rises, people return to what works: tangible assets, finite resources, real materials. Silver sits at the intersection of all of it. Money, energy, technology. That's why this move matters. This is not a trade, it's a regime shift. Those who positioned early didn't get lucky. They understood the structure. Those who dismiss this as hype are still fighting the last war, and history is unforgiving to those who confuse comfort with safety. If you're holding physical silver, this is not validation to sell. It's confirmation to understand what you own. If you're not holding, understand this clearly. The window doesn't close with a bell, it closes with absence. And once availability disappears, price becomes irrelevant. You cannot buy what does not exist. That is where this market is heading. Quietly, then suddenly. This is not fear, it's awareness. Because when systems reach this stage, they don't unwind politely, they reset. And resets don't ask for permission. If this analysis helped you see what's happening beneath the surface, like the video, share it, subscribe. Because this story is unfolding in real time, and when the paper finally breaks, it won't wait for anyone to catch up.